Welcome and thank you for joining us. It's a great pleasure to have with us today Curtis Jensen of Third Avenue Funds. Curtis, welcome.
Oliver, thanks for having us.
Well, it's always great to hear your thoughts, and thanks for being so generous with sharing your knowledge with our audiences. The topic for today is investment process, and certainly Third Avenue has done so much over the years to emphasize the importance of a robust investment process. So we look forward to learning more about that process from you. Perhaps you could just give us a bit of a preview of some of the key concepts that you'll be talking about.
Sure. We've always had a very collaborative and team-oriented culture at Third Avenue. And within the small cap strategy at Third Avenue, we manage about $2 billion of the firm's client assets. We have a team of 4 of us that focus on those assets, and our process is fairly straightforward. I mean, we identify ourselves really as trying to buy improvement at a discount. So if you think about sort of quality of businesses and fundamentals on one axis and valuation on another axis, on the y-axis, and we think of the world as almost being a curvilinear relationship. And along the x-axis, you have sort of your lower quality companies that trade at cheaper valuations, high quality companies. Think of Apple Computer, the A students in the class, right? A for Apple, trading at richer valuations and higher expectations. And then you have a whole world of sort of B and C students in between. And those are generally the kinds of companies that we're targeting. We're looking for companies that are sort of the C students that can become B students, and the B students that can become the A students. And we're looking for those companies when they're trading at some sort of mispricing in the public markets. And as long as we see the fundamentals improving over time and not slipping backwards in any sort of permanent way, we can feel comfortable implementing on those sorts of ideas. And our team finds ideas really from 3 buckets. We're screening the world, of course, quantitatively looking for, we push companies, the Russell 3000 we start with, push them through various screens. A second bucket would also be our knowledge and network. We're talking to looking at portfolios of the people who we admire and look up to, and talking to consultants, investment bankers, constantly talking to management teams looking for ideas in various industries. And the third bucket really is our own internal research team. We have 28 folks here that are constantly generating ideas and sharing ideas with us as well. So we think we have a pretty good platform to kind of start looking at the world and build ideas and create that very important pipeline of ideas. Once we do that, our team of 4 kind of underwrites the ideas. Every week we're looking at new ideas. We grade companies on quality and fundamentals as well as valuation. And we've built a grid for ourselves essentially that creates a weighting for position size based on quality, fundamentals, and valuation. So we've tried to eliminate any of the human emotion and bias that naturally come in this business in terms of creating position sizes. Once a position is implemented in the portfolio, the position size is adjusted based on changes in fundamentals, in quality, and valuation as well.
Curtis, before we get into the specific concept and the graph that you were talking about, perhaps you could step back a bit and just share with us the investment process at Third Avenue, sort of going back to basics, and then how your specific concept of the valuation and business quality graph fits into that framework.
Sure. I mean, the firm's philosophy was really founded around our founders' experience buying distressed companies and companies in bankruptcy and working with those companies. And Marty's experience for many, many years was that he ran across companies that were good businesses, but they were not well financed. And that's where they ran into problems. And that's when he began his career as a getting involved in companies that were in bankruptcy. And out of that experience grew our common stock, our value-oriented investing approach. And the cornerstone of that philosophy really is trying to identify companies that have very strong financial positions, companies that are conservatively financed. We tend to own companies for a number of years. Our turnover is very low. We know that in the ownership and the life cycle of an investment, nearly every company is going to have a hiccup or hit an air pocket in one form or another, right? It's either going to be a competitive threat, a change in the competitive landscape, an industry cycle or a product cycle. We want the company to be well financed enough that there's a cushion in the business for management to stay competitive, continue to invest in the business. So that the cornerstone of the investment philosophy is around trying to find companies that are extremely well financed. We're happy to trade off an element of return on equity for a higher degree of safety in the business. So one thing that you would see distinguishing our portfolio companies is that we tend to have companies that are overly capitalized and have surplus capital, and we tend not to have too many companies that are, have a high degree of financial leverage. Secondly, we're looking for sound business models that we think we can understand, business models that are more likely changing towards improvement. So we are looking for companies. It's very hard to buy the best companies in the world cheaply. They just don't get cheaply that often. So we're looking really to buy improving business models at a discount, or high quality companies that for one reason or another are mispriced in the marketplace, even temporarily. Thirdly, we're looking for management teams that have good track records as owners and operators. We try to look at managements, both, are they making the right decisions operationally and able to execute, but also are asking ourselves whether their incentives are aligned towards building the business on a long-term basis. Lastly, when we have all of those ingredients in place, we're looking to try and buy the securities at a discount from what we conservatively estimate is the intrinsic value of the business. So we create a range of values, kind of on the low end and the high end, and try to go in at a meaningful discount to those sorts of values. Ideally, we're going in at a 20 or 30 or more percent kind of discount to our estimate to protect our downside and try to create as much upside for ourselves as possible.
Now, with your focus on the small cap companies, is there anything that perhaps you need to pay more attention to in that space, and how do you define it versus larger caps or even small caps in the US versus elsewhere globally? Give us a bit of a sense how your specific fund faces any particular challenges in the respect of the overall framework, how it's applied.
Well, maybe I'll turn the question around a little bit in the sense that one of the great things about small cap investing is that I really think you get two ways to win. One is, of course, public market appreciation. The public markets see the value in the assets that you own and put the right sort of multiple on it, and you get that sort of path towards value realization. But when the public markets don't appreciate the value in the assets, and so many small cap companies are overlooked by the public markets, oftentimes you'll get private market realizations, meaning financial buyers or strategic buyers will come in and realize the value for you. that's much harder to get when you own a company like Exxon or GE or Microsoft. As good as those companies might be, the investor there really is beholden to the public markets for value realization. So one of the great things about small cap investing is that I think your odds are a little better in the sense that you get two ways to win, at least relative to larger cap companies. But that said, the business models among smaller companies generally are a little bit more fragile. They are populated by management teams that probably have a little less experience or may not be as strong as larger companies. So we're trying to identify companies that are leaders in their respective businesses, in businesses that there is a path towards growth, growing markets, and that sort of thing. And of course trying to find them at the right valuation.
And when you talked about the balance sheet aspect of the investments that you get attracted to, so very well capitalized companies, I'm curious actually, have you ever looked back historically and is there sort of a figure you can help us understand then these M&A as a driver of closing the gap between market price and intrinsic value? In how many companies has that actually happened? It seems sort of intuitive that with strong balance sheets that those companies could actually be quite nice targets for M&A.
Well, that's another thing where we try to, I suppose, put our approach tries to put the odds in our favor, which is having more conservatively financed companies. It tends to make those sorts of companies susceptible to takeovers, right? Because they're more easy to leverage the capital structures. There's existing cash on the balance sheet that can be used to create a transaction and execute a transaction. And if you're starting life with a highly leveraged balance sheet, it makes it a little bit more difficult to do that. One of the ways we try to test our thesis and valuation, at least, is to put a company through a hypothetical LBO to see if there is room for value creation in that scenario. If we find that the answer is no, it tells us something about the leverage on the balance sheet and our confidence in the business model.
And you've talked also about valuation based on what is. Can you help us understand that concept and perhaps by way of an example?
Well, we try to look at where the company is today. We try to get a sense of where it can be in the future, but we certainly don't have a high degree of confidence about being able to predict the future. So we will use as a test, I suppose, a discounted cash flow to kind of test where where the business could go. But the what is mentality is, how is the business today? How is it relative to where it was in the past, where it might be in the future? And is this a normal state of affairs for the business? A company that comes to mind that's in the portfolio we've added to the position in recent periods is a company called ICF International. It's a professional services consultancy. About a year or so ago, of course, anything in the consulting world that was connected to the government came under pressure, and with good reason. Companies that were connected to the Department of Defense, everybody knew that the government was going to be cutting back its spending, particularly in the defense area. We believe that ICF was unfairly painted with the same brush that all the other consultancies, mostly defense related, were painted with. ICF, it turns out, has about 55 or 60% of its business today comes from the federal government, but less than 10% of it, I think, comes from the Department of Defense and defense areas. So when you peel back the layers of the onion, you'd find out that ICF has business with the EPA, the Health and Human Services, and a lot of other interesting areas in the government. More than 30% of their business today is also commercial. So we looked at the business, we said it was trading at 5.5 or 6 times EBITDA. It was a very cash generative business. Today the business trades at something north of a 10% free cash flow yield. The balance sheet is very conservatively financed. Net debt today is about 1 times free cash flow. The company has done well in growing. It has grown through acquisition. We think this kind of business lends itself to acquisitions. And so we think the company, while a good portion of its business is certainly under some pressure, we think it's also priced as if it's, by the public markets, as if the business is going to go away completely, that it's priced for death. And the business has grown quite nicely over time. Management's executed well, is generating lots of cash, and we think they're in some very interesting areas that have good tailwinds. For example, they're working with utilities and companies working in energy utility or energy infrastructure, healthcare I mentioned, and other areas like that we think have good secular stories to them longer term.
But importantly, this concept of what is means that you're not paying for those opportunities, right?
Yeah, what is meaning we felt the company was mispriced based on, what are the economic metrics in place today, the cash flow generation, the earnings generation, and we think going down the road, it's likely that this company is going to be bigger than it is today, and that it actually deserves a little bit higher multiple than the public markets are giving it. So if the company just continues to go along, growing as it has, or even at a lower rate, doesn't benefit from a higher multiple, we'll have a pretty reasonable investment. If we think the public markets treat it a little more fairly and perceptions change and investor perception changes, this could be quite an attractive investment for us.
Now, to come to the more specifically to the topic of that curvilinear relationship between public market valuation and the business quality, give us a sense then how you define your opportunity set and walk us a little bit through that concept.
Sure. Our opportunity set starts with, of course, the small cap universe. We talk about finding ideas from various buckets. We've talked about screening down that universe of companies in various ways. We talk about a second bucket of ideas coming from kind of our knowledge and network, and a third bucket of idea generation comes from our own internal research team generating ideas, our own team beyond the small cap team. We sit down every week and pour through that kind of inventory of ideas and prioritize them and go after them. Every week we bring the small cap team brings ideas into our meetings. We are essentially underwriting companies. An analyst, including myself, will come in and talk about ideas with the rest of our team. And afterward, one of two things happens. We decide we like it, but we got to get some more questions answered. So the analyst will take it and do some more work on it. We might decide we like it enough, we feel comfortable enough, but we don't like the valuation, so we put it into our inventory of ideas and we watch the stock. The last thing that could happen, of course, is that we have a wide disparity of views, and to the point where we can't get enough conviction, we put every company through a voting process. So our team votes individually, and based on that voting, the idea is either executed on or it's not. And position size is determined by a grid that we use that considers fundamentals and quality on the one hand and valuation on the other.
And give us a sense then for if we pick the x-axis and business quality, what are the elements there to analyze?
So there are, we have a checklist essentially of characteristics that we think comprise good businesses. It's not that we won't buy lower quality businesses, but we just have to kind of size them appropriately in the portfolio and buy them at the right valuation. But essentially you can think of it as a good business as one where you have above average growth. It could be self-financing because of the cash generation characteristics, low reinvestment needs for the business, competition is limited, the business itself is probably not subject to that much change in the future. If you look at something like Apple Computer, for example, of course we don't own it it's not a small cap company. It's a very fine company. I don't think anybody would dispute that. They've grown at terrific rates over the years, but the business itself is subject to a lot of change. I think it's difficult to even understand what a company like that should or could be valued at. So a company like that might be difficult for us to put on the quality spectrum, although I think most people would say Apple is an A type of company, and certainly by most of those metrics it is. And so even though we walk through our checklist of quality characteristics, at the end of the day, when we sit around, we ask ourselves, does this still make sense? Can we still really understand it? Even if we've checked 7 or 8 of the 10 boxes where we think we're getting growth, cash generation, competitive factors, costs and margins, and all of those other factors, those are kind of just a checklist for us, but we still ask ourselves kind of the common sense question and put everything to a common sense test at the end.
Let me just ask you on Apple, since you mentioned it, and we've seen quite a few so-called value funds involved with Apple. What do you think are they perhaps not paying as much attention to, or what's really? I detected some discomfort just with even getting some conviction on whether the business is the quality of it. So what do you think is perhaps the key variable, just setting aside, of course, at a price you can buy anything, but when it comes to just the judgment on that business, the nature of the business, what gives you the biggest sort of unease with business like Apple?
I suppose it's there's no question that Apple is an A sort of company. The question is it more likely to, how much more could it improve versus step back, and how much is the business likely to change over the next few years versus where it is today, and what sorts of expectations are built into the valuation of the business. And I think we've seen over the last 6 months in a stock like Apple, where it was selling at $700 a share last fall, and now it's $400 a share, that even a small step back in fundamentals or a perception of the fundamentals has resulted in a big drop in valuation. And I think that sort of example is reflected in our curve, the S curve that we've developed, where even an A company that has high expectations built into its valuation can fall dramatically in even a very small step back in fundamentals. So one of the things I can identify though with Apple, and it turns out to be the case with a number of the companies that we've either looked at or owned over time, is having a high cash balance on the balance sheet, and the question is, what is management going to do with it? I think something that investors can tend to underappreciate is this notion of capital allocation. Management teams can be great operators. They might have a very good business behind them, and they're going to wake up one day and find out, oh my goodness, we have all this cash building up on the balance sheet, and what can we do with it? I don't know whether it's Microsoft or Apple. I don't know whether their reinvestment opportunities are as good as they have been in the past. For example, you look at a company like Microsoft, they have a tremendous cash balance. It's not clear to me that they have an investment opportunity that's better than their Windows operating platform. So what could they invest in that would be take the business to the next level? Similarly with Apple, it's not clear to me, and I don't know anything about Apple, but not clear to me what they can use their cash hoard for, and whether or not getting a sense of whether management's inclined to return some of that cash to shareholders is always an important question. What are they going to do with that cash? Do they have good opportunities to reinvest in the business, make acquisitions at sensible prices? These are all questions that we find ourselves asking because so many of our companies do have this conundrum in a way. It's a high-class problem to sit there with a lot of cash in the bank and contemplate what to do with it.
I want to get back to that S curve that you talk about, and if you could perhaps just to stay on that x-axis, so business, and then what are the other elements there that you analyze to really be able to grade it, I think, on a scale of A to F?
Right. I mean, we don't think it's enough to simply go out and buy high quality companies and just wait for time to, in the fullness of time, you're going to have a good investment. What we're looking for are changes in business, of course, in a positive direction. So I'll try to talk about an example. One of the fund's larger holdings has been a company called Teleflex. When we invested in Teleflex about 2 years ago, it was a conglomerate. There was a bad taste, I suppose, in investors' mouths because management had overpaid for an acquisition. No one on the sell side knew how to value it or really follow it because they had industrial businesses attached to a medical equipment business. But when we came across it, we noticed that they had divested some of the industrial businesses and they were on target to divest the remainder of the industrial businesses, and they were headed towards becoming a pure play medical products company. And when we drilled down a little bit further, we felt like there was a lot of low-hanging fruit in the medical devices side of the business in terms of cost cutting and margin improvement that wasn't being reflected in the current economics of the business. So going back to this notion of what is and buying what is today, we felt as if there was some hidden earnings power, a lot of runway for margin improvement, and misperception in the marketplace that was not being reflected in the current valuation of the company. You roll forward about a year, the company the thesis has played out pretty well. They've divested the industrial businesses. they sold them for cash, so that in the process, the balance sheet actually got better. The medical devices business, which is fairly attractive in the sense that they deal in a lot of consumables, has flourished as well. They brought in new management to guide the business, and it's being reflected in the valuation today. We're still quite fond of what the business is doing and where it's going. So
now, when we look at the S-curve, then for that example, it was perhaps when you invested in it, it was perhaps one of those.
it was probably maybe a C plus, B minus type of student. We knew that there was some raw material in there, if you will, that could move in a positive direction. We had tangible evidence that the management was going to affect change and get rid of the industrial businesses. They had hired and said publicly that they had hired a banker to get rid of the remaining industrial businesses. So we knew the balance sheet was going to improve. We felt as if the multiple could improve, that it would go from a conglomerate multiple to a medical devices type of multiple, and that there was a very, very real pathway towards improvement in the medical devices business itself through new product introductions, a new, and better approach to pricing in the marketplace, and those sorts of things have played out. So today, the business is probably in that B to B plus type of student. We've gone from a kind of C plus to a B plus, and the thesis continues to play out. So,
but it was key that when you invested, you saw enough there in terms of business quality, also management. You mentioned new management that came in.
A new management, new CEO came in. It was a fellow who had been on the board, and he had a lot of experience at one of the company's competitors, CR Bard. So we felt as if we had some confidence in his ability to. He'd been connected to the company, seen the history, knew the portfolio of products, and from both a competitive standpoint and being inside the company, and felt like he was the right person to lead the business.
And then perhaps another key element, the financial strength. So in this case, this wasn't a turnaround where the change, it was a matter of just divesting the non-core, focusing. It was a matter of focus.
It was more, it wasn't as much of a stretch in terms of a turnaround. In other words, the existing pieces were in place, and it was more about execution. And so far, management has executed well. Margins have improved as they sort of previewed, and as we thought in our original view of the company. It is a net debt company today, but certainly not an onerous debt position, and doesn't stretch the company's balance sheet. We feel like the test is always whether or not a downturn in the business and whether or not the balance sheet would threaten the company's business and impinge on management's ability to continue to invest. In the case of Teleflex, there's no real question.
And so just to conceptually think about it, then when you invested, it was somewhere off that S-curve, and then it is getting back onto it, and that's sort of how you make money on your investments.
Yeah, when we looked at Teleflex, for example, in terms of valuation, because it had sort of some industrial businesses and some medical device businesses, we looked at it as maybe a sum of the parts, kind of broke apart the pieces of the business. But in aggregate, the public market was still giving it a kind of industrials broken industrials kind of multiple, say 5.5 or 6 times EBITDA. And as we saw it, when we looked at preceding transactions in an M&A context or public market comps, we felt like the medical devices business on its own should have a much higher multiple. So that we really have 2 tailwinds potentially for ourselves, right? If they got rid of the industrials business, they executed in the medical devices business, and the market recognized it as a pure play medical devices business, we'd have margin expansion and probably multiple expansion at the same time, and you sort of get that double kick.
Now, I want to go back to, I think what you said earlier about, so in effect you're buying change, improvement, and you're getting it at a discount because of the way the market perceives it. But importantly, you say that it's not sufficient to simply buy cheap companies and sort of hope for the best. So those would be, that would be that area on the graph in the lower left-hand corner where the valuation is low, but the business quality, the management, perhaps the financial strength also is just not there for you to see an opportunity as an investor.
It's our belief that also that investors may be at risk investing in companies whose business models are weak and weakening further. And really at a certain point, and is reflected in this curve, valuation doesn't matter, because even a small step back in a weakening company that continues to get weaker, you can still lose a lot of valuation under those circumstances as well. So we try to avoid, what we think are weak industries, weak business models, even if there's an opportunity for a short-term change in the business. That said, we won't completely avoid what we think are very difficult businesses. Some cyclical business, for example, we own oil and gas land drilling contractors. It's a very difficult business. Virtually every risk known, every business risk one can think of, whether it's labor risk, commodity risk, cyclicality and capital intensity. So we give that group of companies, probably a C or C minus as a fundamental kind of business. I mean, they're probably one step up from owning an airline. So very, very difficult business. But they also have volatile stock prices connected to them. Sometimes they get so mispriced in the marketplace that we will implement a position, again, provided that the balance sheet's strong enough to carry the business plan out. At those times when the cycle is so out of favor and the stock prices are so out of favor, we may have a very small position in a C minus company where we think the fundamentals are likely to improve, even if it is only a 1 or 2 year holding. We think of those kinds of investments as traders as opposed to compounders.
But what would be, just to help us understand the concept better, could you give us an example of sort of a situation that was far enough into that lower left-hand corner of the graph that you passed on it?
Well,
or if I just throw out some, just perhaps even outside of the small cap space, the perception perhaps with a business like Nokia would be that it's just hopeless. It's sort of in this on the x-axis it would be perhaps toward the F, or with, let's say, some of the Japanese companies like a Sony or some of these electronics businesses. I think the way most people would grade those would be almost an F, just very little hope.
It could, I'm not, I suppose, not as quite familiar with those companies, but, it would really require both a bad business model that is deteriorating as well as a bad balance sheet to put it in, I suppose, true F territory. I mean, some of the land drillers, oil and gas contractors that I mentioned, the business models are difficult, but they have very strong balance sheets. And so that would take them up a notch in terms of fundamentals and quality. And, we'll take a look at a company like that. But when the balance sheet started to deteriorate and the business quality and the fundamentals on a longer term basis, in what is our view continuing to deteriorate, those would likely have not have a place in the portfolio, regardless of valuation.
One of the things that really I'm getting out of this is that this capacity to be able to change and so sort of self-help yourself with a good balance sheet. So in that lower lower left area of the graph, it's really not just a bad business, but also a bad balance sheet, let's say, where you just cannot move to the right on the graph because of these constraints, and then the valuation becomes very tenuous and what looks, especially for the equity, which can be a sliver. Is that the right way to think about it?
It is the right way to think about it, and I think that notion of self-help is very important. And we try to align ourselves with well-financed companies because having a strong balance sheet is, we think, critical to that ability to create self-help in the business. It's just sort of an anchor to windward in terms of protecting the business, keeping it competitive, allowing management to make the right investments, and buying time for an investment. One of the areas where we're constantly asking ourselves a question is management's plan realistic? Do they have tangible and specific ideas, levers on which they can pull to create value and improve the business? And are they backed up by this strong balance sheet? And then if they do, we kind of ask ourselves, what is sort of a realistic time frame into which the management can carry out its plan? So many investors are impatient. They haven't been involved in industry. They haven't worked in real businesses, so they think that management can flip a switch and change a business around in one quarter, and that's actually where being a longer-term investor gives us an edge, in a sense that we do have this patience. We have a longer-term focus. We're not short-term oriented. We're not driven by a monthly P&L, and we realize through decades of experience that it does take time to carry out a plan. That said, we don't have an infinite amount of patience, and so many management teams have kind of aspirational goals. They'll do the presentation. Their margins today are 8%, and they say, well, we're going to get them to 12% by 2015. And when you ask the question, lay out the specific route by which you're going to get there, they don't have a good answer. So you have to be careful, number one, around sort of aspirational goals, what's realistic, and trying to gauge a time frame, because of course that's going to affect your return.
And so, in the same vein that you say it's not sufficient to simply buy cheap companies and sort of hope for the best, you also say, and that would characterize that lower left-hand area of the graph. But by the same token, you say that it's, nor is it enough to simply buy quality companies. So that would be those on the right, upper right area on the graph. Could you give us perhaps an example, however, and I think you talk about that as well, it's that you like to buy mispriced qualities, so where a company, I guess, is all the way to the right, but for whatever temporary reason, there is a perception that it's moved back to the left, and the valuation sort of in the public market has started to reflect that, and that gives you an opportunity. Could you give us a sense of what would be one such example? And I think Apple, some people may, given the share price decline, perhaps perceive that it may be such a mispriced quality, but we don't need to talk about Apple.
These kinds of opportunities created in the marketplace for various reasons. One is, for example, orphan securities. Oftentimes a company will be spun out, there's no coverage, it'll be neglected by investors for a period of time. And that was the case with our investment in Madison Square Garden, which was spun out of Cablevision 2.5 years ago. And there was additional pessimism around the business because management had laid out a plan to spend a lot of money renovating the garden. They had said they had a 3-year plan to spend around $1 billion, which is sizable in relation to the company. And but we felt like the business was very attractive, on a fundamental basis, that if Madison Square Garden, the Knicks and the Rangers and its content were sort of must-own content, and it was almost a unique asset in a way, and that if they could carry out their business plan, that there was significant improvement in the economics coming. They started life with a very strong balance sheet, again going back to this idea of self-help and having that strong balance sheet. The business model itself was cash generative. I think they started, when they were spun out, they were at a net cash balance sheet and generating lots of cash. So we felt as if the business could easily handle $1 billion investment. And the investment is now, we're almost 3 years into the renovation of the garden from the time of the spin-off. It looks as if the renovation has been a success. The economics of the business have improved, and the company will, finish this year, finish post-renovation, it'll have a net cash balance sheet, still debt-free balance sheet. So we think in addition that there is even room now in the periods ahead for management to consider returning capital to shareholders in the coming years. So that one was it was just sort of an orphaned spin-off. But A kinds of companies also get mispriced for other reasons, temporary reasons. We own a company called Compass Minerals, which is arguably the largest producer of rock salt used in road de-icing in the country. It's really a duopoly business with very, very high barriers to entry. Of course, it's a commodity business, so there is some misperception around that as well, because if you look at the business, there is pricing power in the business despite it being what is ostensibly a commodity. And importantly, the company benefits from having very low-cost operations. So again, here was a company that was investing for, its capital expenditures had spiked in order to expand operations. We knew that this was going to be temporary, that it would lead to greater earning power in periods ahead. And of course, 2 years ago, we had a very warm winter, and the stock was knocked down because everybody assumed that the warm winters would last forever, that there would be no more snow and no more ice on the road, no more salt on the roads. And we were able to find it a very attractive entry point in the 60s. And of course, things have started to normalize in terms of that end of the business, and more normal snowfall, and so sometimes very good businesses are just, the valuations change just because of temporary situations, and if we're prepared and our inventory is well prepared, we're ready to act.
Just a quick follow-up question there. You mentioned the pricing power despite sort of the ostensibly commodity nature of the business. Is that really due to the industry structure? What's the...
It is a little bit due to the industry structure, and what you find is that the volumes tend to go up and down, of course, with the weather and municipal governments and their ordering patterns and their existing inventories. But it turns out the producers are able to, every year, tick up pricing just 1 or 2 or 3% a year. And it's sort of a small part of the overall budget, and it's kind of a low-cost item in a sense, so that it's really, I think the pricing power also derives from the fact that it's not necessarily a discretionary item. I mean, there's only so much you can cut back without sacrificing safety on the highways, and so it's that idea that there's high barriers to entry business. There's a limit to the amount of discretionary spending that the customers can do, and the duopoly nature of the business.
So thinking about to come back to the framework, the graph, you are then concentrating on these C and B type businesses that are sort of in the middle on the x-axis, and as well as perhaps some grossly misunderstood A companies, which are anyways further right, perhaps, but just there's a misperception. Is that a fair way to describe it?
If you looked at the portfolio today, the vast majority of our companies would fall into that B and C type of category. It is typically, the market's efficient enough that the very best companies don't get mispriced that often. And so we'll get a chance once in a while to own an A company. They tend to be in that category of compounders where we're actually willing to buy a company like that at a less of a discount perhaps, because we believe the ability to compound is greater over time. So where if we wanted to own a C company in any sort of size, we'd really demand sort of a 30 to 40% discount to intrinsic value. But for an A company, obviously if we can find it at a 40% discount, we'll make it a very heavy position. But we're also willing to own some of it at even a lesser, 10 or 15% sort of discount.
And I guess the further left you perhaps would move on the graph, on the x-axis, would perhaps portfolio management then come into play more, and the position sizing, you could mitigate some of the other variables in terms of just your overall portfolio and exposures, but still get involved with sort of toward the left on the x-axis.
Yeah, typically the companies that are in that left side in terms of quality, the C's and the D type companies, and I don't know that we even have any D's today. We generally avoid, if it's something that's really on the edge, we'll generally just avoid it. But the way our position sizing matrix works in a sense is that we try to protect ourselves by controlling the position size, and those companies that are lower in quality, they're going to have a much higher discount in order to achieve the same sort of position size that a B or an A type of company would get in the portfolio. And it turns out to be the case that we control position size for those types of companies just because we don't want to load up the portfolio with all C's, even if we felt like that's where we're finding ideas. We want to have a bit of a balance across the portfolio, because at any point in time, it turns out that high quality companies are in favor at some points, and lower quality companies are in favor at some points. And so in order for us to be competitive in a relative performance sense, we have to have some balance across the portfolio.
And that's perhaps a related question to that is how this framework is applied throughout, let's say, the business cycle, or going from a sort of time 08 to 09, financial crisis, lots of sort of panicky markets, versus perhaps now in 2013, where some could say it's an elevated sort of market again. How does the opportunity set change, or sort of have you identified any sort of better areas depending on the business cycle?
Maybe it's almost more of a market cycle question, and we're certainly not market experts, and we don't spend a lot of energy and time trying to figure out where the markets are going, but we do try to figure out where the markets are kind of giving us opportunities. Today it's harder for us, and I don't know if we're unique, but it's harder for us to find those deeply discounted securities. So our default, and I think you'll start to see it in the next quarter or two in terms of our portfolio construction, has been to put on smaller positions in higher quality companies, and what we think of as higher quality companies. And we're prepared to buy more if the market goes down. We sleep a lot better at night if knowing that we have conviction about a higher quality company we can add to it, as opposed to if economic conditions deteriorate from here and we're owning some of those weaker companies, things deteriorate from here, we have a little less conviction about adding to those positions. So we're trying to spread our bets out a little bit more. We've identified some names in the financial services area, looking at banks. We feel like that's a sort of an out of favor area that could benefit in the years ahead as should the economy grow.
And are we talking there about more of the community banks?
Smaller and mid-cap types of banks. Businesses where we think, again, there's maybe just misperception around. We added a retailer where we think there's sort of pessimism around employment trends and consumer pocketbooks, but we feel like we've got a good franchise that's got a track record of growing over time. And these are names we haven't publicly disclosed yet, so but the portfolio, I think you'll see the shape it's taken is to be, the position sizes have kind of gotten flatter in a sense. We don't have any massively discounted things that are heavily weighted in the portfolio at this point. If we went back to a period like 2008, 2009, what I think you would see are fewer positions, bigger position sizes in higher quality companies. We'd be very happy to own 35 or 40, what we think of as high quality companies trading at big discounts, as opposed to today, we're headed more towards that 65, 70 positions type of portfolio. Smaller positions, a little bit less conviction probably because we don't see the kinds of discounts that we'd like to see.
And that's, just to clarify, your focus is solely in the US space?
We have room to go outside of the US, but the mandates that we manage generally are interested in US companies.
Now, in that graph framework, that S curve that defines sort of the opportunity set, so that would be that box that's sort of below the curve, more towards the right on the x-axis. I'm curious then, it seems very sensible to me, and I've learned much more about how you think about those opportunity sets. one question that I have is just, what do you find the most challenging aspect of applying that framework in practice? So what's the most difficult thing when it comes to buying change?
Well, there's two things, I suppose. Maybe there's more than two, but one is time frame. I mean, that sort of time horizon risk is always there for investors. Sometimes you get lucky and things play out in sort of short order and it enhances your returns. Other times things drag on for much longer than you might have imagined, and of course that sort of scenario hurts your returns a little bit. So time is an important factor. If we think that it's going to take longer to play out, we'll demand a higher discount, and also probably put even more emphasis on the financial position. If we think something is going to take 2 or 3 years to kind of fully blossom, then we want to make sure we have a very strong financial position behind it, and we're really conservative about the valuation. So time is always a risk for investors. And it kind of goes back to, I guess, a second factor is thinking about management, their track record, their ability to execute, their willingness to make the hard decisions. If it's a cost-cutting story, it's not easy to go in and lay off people and close factories. It's not that easy necessarily to execute on new products and get them out. So again, you try to build in a protection for yourself as an investor by buying at a discount in case either management can execute or it takes longer than you thought it would.
And that reminds me of a passage in the latest letter where Marty Whitman spoke about if industries are to continue to experience meltdowns and if certain companies are to be poorly financed, then well-financed companies with opportunistic managements will continue to have opportunities to make ultra-attractive investments into situations by reorganizations, capital infusions, or by acquiring assets. And I'm wondering, in your smaller cap arena, that importance of opportunistic management to add value, I guess you said that one of the challenges is to really get comfortable with management, but when you can and you get that right, is that perhaps really the kicker in the small cap area for really applying that framework successfully?
Well, that comment I think goes to management's, it's that capital allocation. It's management, for example. They see their stock price is very depressed and they know they have good long-term prospects. Are they out in the marketplace buying back their stock? Are they able to identify acquisition opportunities that make sense, value them properly, and execute on making the acquisition? That those things aren't necessarily that easy to do. So it goes to that idea of capital allocation and an ability to execute. But I think, again, there's another reason to align oneself with a strong balance sheet and a lot of financial flexibility, because in the case where, the idea that management has multiple paths to value creation and improving that business value per share, right? So if they can't go out, if they don't have great opportunities to invest in the existing business, perhaps it means they go out and do an acquisition. In the cases where they don't see a great acquisition, they still have the financial flexibility to buy back stock or return capital to shareholders in the form of dividends or extraordinary dividends or those sorts of things. So we think it's another reason just to have that optionality in the business and having multiple paths towards creating value for the equity.
Now that we've talked about the the concepts and the framework in general, and you've given some examples, but how do you really go about applying that framework day to day? Can you give us a sense of what you actually do, what your analysts do to apply that framework?
We get together every week as a team. I mean, we're getting together every day, but formally every week we're getting together and looking at companies. Generally, there's an analyst assigned to a name. He'll bring it in, present it to us. We'll ask questions. Sometimes the idea needs to go back out of the room for more work and more questions to be answered, more diligence. Other times we're prepared to act on it. Our thinking is complete in as much as we know at that point. And we put it through a grading process. So each of us as analysts grades a prospective investment based on fundamentals, business quality, and valuation. And when it goes through that process, there is a proposed position size, and this is not we don't automatically follow what our model says, but we ask ourselves, does this recommendation based on our group input make sense? We subject it to a common sense test. What does this investment mean in terms of what does it bring to the portfolio? Are the business qualities and characteristics making sense in terms of what else we own in the portfolio and the kinds of discounts that we see in existing holdings? And how does it compare? How does this prospective investment compare to something else we have in the portfolio? And in a sense, we're acting as capital allocators, and there's a fight for capital in the portfolio. And if we see something that is not as attractive relative to this prospective investment, that one will go out, and this one will likely go in.
Well, on that note, Curtis, I really want to thank you so much for shedding more insights into this so useful concept for investors to hone in really on the mispricings that may be out there.